Hello, everyone, and welcome to another Altos Trading Live Strategy Session with Jeff Tompkins. This is your host, Richard Van Rich, and we have Craig Ward with us also in the chat. Happy Tuesday, everyone. Hope everyone's having a great week so far. We had a great 3-day holiday weekend. Got a lot of information to go over tonight, so if this is your first time on, you'll notice that all microphones are muted. That's so we can hear Jeff and I talk, but there is a Q&A box located at the bottom of your screen. So if you just move around your cursor a little bit, you'll see a Q&A and chat box. Put questions there, and we'll get to those throughout the evening and also before we sign off at the end. If you have to hop off for any reason, don't worry. This is recorded and will be available in the members area sometime tonight and on YouTube sometime tomorrow. So if you're watching this on YouTube, please like and subscribe so you can get more of our videos. We're putting those out every week. And if you have any questions about your personal account with Altos Trading, trade alert services, open alerts, access to trade Transillion, anything like that, email support@altostrading.com, and we'll get to those sometime tomorrow. We're bringing on Jeff. Let me just read the disclaimer. Altos Trading LLC and Trade Transillion software is intended to be used as an information service for subscribers, and it includes opinions as to buying, selling, and holding various stocks and other securities. However, the publishers of Altos Trading, Trade Transillion softwares are not brokers or investment advisors and do not provide investment advice or recommendations directed to any particular subscriber in view of the particular circumstances of any particular person. Altos Trading LLC, including its owners, do not accept responsibility for any decisions made by subscribers using the software, and subscribers to the Trade Transillion software or any other persons who buy, sell, or hold securities should do so with caution and consult with a broker or investment advisor before doing so. So that being said, Jeff, if you're there, you want to tap in?
Greetings and salutations.
How's it going?
Oh, pretty good. Had a nice 3-day weekend. I hope all of you did as well.
What'd you do?
Not much of anything. That's why it was so nice.
It was fantastic.
Yeah, a little bit of downtime never hurts anybody.
That's awesome.
Yeah, kicking off the week in the markets at a pretty significant inflection point. So I think this is a good, timely market environment for us to hold our session in tonight. We're going to cover that and map out all of our key levels. We'll spend less time on market overview tonight. We've kind of monopolized the last 2 weekly sessions just due to the fact of wrapping up the year and starting out the new year and having more to cover there. But there are some key levels we need to keep an eye out for, as well as trend lines. So we'll take a look at those tonight, and also review our 36-month moving average and where things stand in the month of January, and what that might be telling us as we move further into the year. And we're going to focus tonight on the VIX in particular. It's also a good time to be looking at the VIX because it's at relatively low levels, some of the lowest levels we've seen in the past year. And typically when, the VIX can stay low for extended periods of time, but typically when we get down into this low territory, especially as it coincides with significant resistance levels on the major indices, we often see some degree of a VIX spike. So we're going to talk about different ways to analyze that and even trade it. If we want to use the VIX for hedging purposes, portfolio protection, or speculative purposes, in terms of making money on any spike in volatility in the markets or sell-off in the broader markets. So that's going to be our topic for tonight. And it's going to build on some of the things we've talked about in previous weeks, like volatility skew, and how to select the right option strategy. And we'll look at probably a few different option strategies as it relates to playing the VIX. So really excited to cover that tonight with you guys, and then we'll leave some time for ticker roundtable at the end, and wrap up with our Q&A session. With that said, if any questions pop in your head during the session, please feel free to put those into the chat or the Q&A, as Richard mentioned. We love for this to be interactive, so don't be shy. Ask any questions or make any comments that you might find beneficial to yourself or any of the other members on with us tonight. Kind of good turnout tonight, so it looks like everyone's striving to kick off the year strong, and so far so good. We've done very well this year. I mean, we're only 17 days into the year, but things are going really well across our spectrum of strategies, and I expect that to continue. So let's go ahead and hop over to our charts and take a look at the key levels that we're watching for this week. So let me go ahead and refresh our dashboard and get today's current data. And we'll start out taking a look at the S&P 500 index, the SPX. So we've kind of stalled out here. We had this range that we were stuck in for several weeks back in the end of last year. So late December, we talked about in previous weeks this range, and that breaking out to one side or the other might give us a better indication of where the markets are likely headed early 2023 Q1. Right now on the horizon, we've got kind of a slew of earnings that are likely going to be the catalyst that determine whether this uptrend and breakout of that previous range continues, or we reverse back. So one thing I want to point out is we are at the upper range of our volatility band. So the SPX is currently trading 2 standard deviations away from our center band, our mean or average, which is a 20 period average. Okay, so we are at a dynamic resistance level. We're also at a significant upper trend line. So I'm gonna annotate that right now for you so that we can see where this trend line that we've kind of bumped up against, and it I think it was last week we talked, or it might have been 2 weeks ago, we talked a lot about confluence between static and dynamic support and resistance. So this really comes into play not just with horizontal resistance, but also with dynamic resistance, which is our upper volatility band, and a trend line. So we've got kind of 3 different factors as it relates to, in this case, resistance, both horizontal static, trend line static, and dynamic resistance. And that all aligns right around the 4,000 millennial mark on the S&P. So if we look back at this trend that we've been in, and we draw the trend line from highs back in March of last year, and we can actually extend that out even further back in time, but not really necessary. We're really in this ranging channel. So what we want to be looking out for, we can draw the lower end of this channel as well. What we want to be looking out for is whether the upper end of this channel, this resistance level, will hold this week. And so we encountered it really yesterday, or not yesterday, it was holiday, Friday and today, and particularly today. And you can see we had a bit of a bearish reversal, right? So if we look at today's high, which just breached the 4,000 millennial mark, so 40.1539, we reversed off of that and then closed back below that 4,000 millennial mark. So we closed at 39.90 and change. So this is really critical to watch, because if you look at past times in the past where we've encountered this resistance line or resistance trend line, in the context of this downtrending channel, we've had significant rotations lower. They become a little bit less in terms of magnitude, particularly the last rotation off that upper trend line back in late November, early December, which can sometimes foretell, that this downtrending range and this upper trend line here has a greater likelihood of breaking. And if it does, that's really going to open the door for higher prices. And when we look at that in the context of the monthly chart, as we'll look at here momentarily, and the 36-month moving average, there is a fairly strong base case scenario for that occurring. But again, that catalyst there is going to be probably going to be earnings. We had a softer than expected CPI for December, and that's assisted in this most recent run up into this upper trend line here of the channel. So we've got all this confluence here right around of both static and dynamic support, or sorry, resistance right around that 4,000 level. So we want to watch are we going to rotate lower and make another leg lower off the upper end of this channel again, or are we going to break out? And I think if we break out, there's a fairly low likelihood of a false breakout. And if you look at how past occurrences around this channel, which also coincided with both static and dynamic resistance, you can see that these all of these lower legs off this trend line from December, August, March were at also after the S&P trailed the upper volatility band, right? So we've got again a confluence of static and dynamic resistance. So that's why it's so key to be watching this week, and even starting, if you haven't been watching it, starting tomorrow. Let's see what happens. And it may become a bit more clear as we incorporate the VIX into this analysis, because again, the VIX is now moved below 20, and we want to watch how the VIX reacts around that 20 level. We'll look at that here momentarily. So, so we've got this trend line. We've got we've encountered our 2 standard deviation upper volatility band. We've got a horizontal resistance level around 4,000, which again we closed below today on the S&P. So those are the things to really be watching. If we rotate lower, you can see that our center band, which is starting to kind of slightly slope up, will likely move up into the 3,900 century mark, which is a level of support. 3,800 is also a level of support, and 3,750, a half century mark, which also coincides with the lower 2 standard deviation volatility band, is more confluence with static and dynamic support. So we've got a few lower layers of support. In order for us to encounter the lower end of this downtrending channel, we'd really have to sell off strongly. As you can see, if we extend this out, we're looking at levels on the S&P well below 3,400. So that's going to be, if it makes another move towards the bottom of this channel, much more of a medium to longer term factor. So that's really what we want to be keeping an eye on right now on the S&P. And let's actually just go ahead and look at the monthly chart real quick, because we focused obviously a lot on the 36-month moving average. So each of these candles is 1 month of trading data. And we again talked about the confluence of static support here. This is actually our bear market line, which we're currently out of technical bear market territory on the S&P, right? So that's right around 3,850. Although we had a close below our 36-month moving average last month in December, we've rotated higher, and currently, we're still got a little time left in January, but we're well into the month, and we're trading near the highs of the month on a strong bullish bar, albeit an inside bar. So our high and low, the range of this month resides within the range of last month. But this has bullish implications. So again, if we do break out, and this is where I was saying there's a strong case for a breakout of this channel on the daily chart that we just looked at, as it relates to the monthly price action, right? So if we do break out of that channel and continue to rotate higher in the month of January, it's going to increase the likelihood that we stay out of bear market territory, and it really opens the door for much higher prices on the S&P. So let's take a look at the NASDAQ 100 ETF, the Qs, and take a look on what's going on with tech. So similar case with confluence between static and dynamic resistance, which resides really around 280. And you can see that small here, but today's price action, let's actually see what the low print was. Just not many ticks below at 279.59. So you can see that intraday today, we actually slightly breached that 280 level. So right now that's actually support. But I'm also looking at it as a bit of resistance. So yeah, we closed above our low breach, slightly breached, and then closed above that 280 level. But when we look again at the dynamic resistance, our 2 standard deviation upper band, there's a lot of confluence around here, right? And we have a similar trend line as we do on the S&P, but we're not quite up to that line yet. So we still have a bit of room to move here on tech. So interesting, you know, maybe this will, since obviously the NASDAQ and the S&P tend to move in some degree of tandem, this may be good news for the S&P if the NASDAQ 100 can continue to move higher, and we can break that that upper trend line on the S&P, that resistance zone, then we might see the markets continue to rotate higher, a bit higher. But on the NASDAQ, since we haven't quite encountered that trend line yet, we really need to see this. We need to see the NASDAQ break this to open the door for higher prices on the Qs. So technically 280 is support because we're trading above it. But again, I also want to kind of, it's a rare circumstance. I want to look at this also as a resistance zone. Okay, so let's now take a look at the VIX. Which again is at relatively low levels. We're below 20, right? But we're also near a major support zone. And what we want to look at here, I'm going to zoom out even a little bit more. Is this support zone between 18 and 20. We're going to talk about how to use this support zone as we get into our strategy for tonight, which is trading the VIX. Okay, so this support zone, if you look at past times in the past where we've encountered this support zone, right, between 18 and 20, so early December, mid-August, late March, early April. Okay, so this is going back all the way, this is last year. So if we go back a year, every time in the past year that we've encountered the support zone, we've seen quite significant VIX spikes, which correlates to what? A subsequent sell-off in the indices. So if we look at the timing of this, why is it important? Well, because we're at a resistance, a confluence of static and dynamic resistance on particularly the S&P, but also the NASDAQ and the Russell, even the Russell 2000. And we're at a support zone on the VIX. So if we can stay within 18 and 20 or even break this support zone and rotate lower, which we haven't really done since 2021, right? So going back here to 2021 is where we really spent a lot more time down in this these lower VIX levels. But for the last year, anytime we've encountered this support zone, we've seen VIX spikes up into the 30, 38, roughly speaking. We obviously intraday breached that 38 level, but that resistance zone, right? So what does this all mean, and how do we use this information to our benefit? Well, if we see the VIX break 20 and start to spike, and we see the S&P and the other major indices rotate lower off that upper trend line resistance, that's our indication that that this current run up in the markets is reversing. Conversely, if we see the VIX stay between 18 and 20, or even break below 18, and we see the S&P, for instance, break that upper trend line and start to rotate higher, which again there's a strong base case for that. If we look at the S&P monthly chart and the 36-month moving average, and where it resides for the month of January, then it opens the door again to higher prices in the broader markets, and we might see something more similar to what we saw in 2021 with VIX down at these lower, 14 to 18 levels. So right now there is a very real and significant chance of a VIX spike. But for that, I'm really looking for confirmation of the VIX breaking and closing above the 20 level. And another thing to look out for, I was going to point that out on the daily chart. We can do that when we go back over to the daily chart of the S&P. You'll notice that the ranges of the high and low of the daily candles on the VIX, but also on the S&P and the NASDAQ and the Russell, are more narrow. So volatility has subsided. So if we see the range, the daily ranges from the high to the low start to widen to like what we saw last week, to the upside, that is a good indication of a VIX spike as well. We don't currently have a trade trend buy signal. That's also something I watch very closely for when we're down at these lower VIX levels. If we get a trade trend buy signal down at these low VIX levels, it's historically a very strong and accurate indicator of a VIX spike and a market sell-off. And then if that occurs, we use these resistance levels, 25, like we looked at 28 to 35 and 35 to 38, as is our tool for helping us determine when the sell-off is going to potentially stall and then reverse back to the upside. So right now, with VIX levels being at lows that are kind of in the vicinity of the lows that we've seen on the VIX over the past year, there's high potential for a volatility spike, and volatility is either contracting or expanding at all times. And so the easy way to really determine that is if you see, again, the range of the candle narrow, then it's volatility contraction. If you see the range of the candle wide, getting wider, it's volatility expansion. So that's useful to know because, if we're looking at the S&P, and this can be applied to any asset, whether it's a stock or an ETF or forex pair, whatever it is, when we get bigger directional moves like we've had over the last week or so, you'll see that we have volatility expansion on the S&P, right? And then notice how when this breakout occurred back around January 6th, gradually the range of the candles from the high to the low gets more narrow, right? And today it's very narrow. So this is a period of volatility contraction. And what is volatility contraction followed by? Volatility expansion. So it's a certainty that we're going to see volatility expand. We just don't know if it's to the upside or the downside. But since we have such a narrow range from high to low, we're on the edge of a volatility expansion. So these are all the factors that are kind of lining up right now in the markets as it relates to support and resistance, both static and dynamic, volatility, contraction and expansion, trend lines, all of these things. So that's very helpful because if we see a volatility expansion in one direction after a volatility contraction, those tend to result in sustained moves in that direction. So if we get a volatility expansion, a wider ranged green candle or bullish candle breaking out of this trend channel, then our bias is bullish. If we get a volatility expansion to the downside off this this zone of confluence of static and dynamic resistance and a volatility expansion with wider ranges and a red bearish candle, then our approach is bearish. Okay, so that's the S&P, NASDAQ, and the VIX. We'll pause there for any questions, and then we're going to take a look at the VIX. I actually put a trade on the VIX in my trading account, and I'll share that with you guys tonight, and kind of why I did it and what the potential risks and benefits are of it. But any questions, Richard, on the market overview?
Funny, like it's got the total segue question that you halfway alluded to. Stephen asked, should we be buying VIX calls to hedge our portfolios? So I guess you'll get into all that.
Yeah, so we'll talk about ways to use the VIX. I think it's a time, it's as far as like time, admittedly, I probably put my trade on a bit premature, but I gave it a lot of time. I didn't put on a short term, and again, I'll share my actual VIX real money VIX trade that I put on in my account with you guys tonight. But I put it on and gave myself a lot of time, and enough time that I think the likelihood of a VIX spike it has a very high probability of profit. But the VIX, it could, who knows, it could stay low, and we could break out of this downward trending channel, and the trade could lose, right? And I have some ways, and I'll share those with you, that I can make adjustments to that if it occurs, if and when that time comes. But I think, yeah, right now, it can make sense with VIX being at low levels and encountering these areas of resistance in the broader indices. These are the times where it can make sense to be cautious, and hedge positions, or even put on a speculative trade on a potential VIX spike. But we just want to give ourselves enough time for that to occur, and look for factors to line up, right? So like I mentioned, we still don't have a trade trend buy signal yet. So I'm really watching out for that. And if we get one and we start to spike up on the VIX, I might even add to my position or set up another spread. But let me show you what I set up and kind of why I did it, and what the potential profits are. So I set up a position on a spread. So I set up a bull call debit spread on the VIX. And, to be clear, this isn't a recommendation to set this spread up yourself or to do exactly what I'm doing. I'm just sharing with you kind of what I did and the rationale behind it. But I went all the way out to the March expiration. So I'm giving myself 63 days, right? So the VIX is at, again, some of the lower levels that we've seen over the past year. We've historically seen a lot of VIX spikes. We're at a resistance level on the major indices. So I may have done this prematurely because we actually haven't broken out of that VIX support range between 18 and 20 to the upside. And that's why I really gave myself plenty of time. So it might not happen right away. Maybe it won't happen at all, but I wanted to give myself plenty of time. So I went out 63 days. Did I put this on today? I can't remember now if I put this on Friday or today. Too much going on, but I just recently put this trade on with plenty of time for it to play out. So was it last week or the week before we talked about how to select, I think it was last week, the best option strategy based on implied volatility. So if we use volatility skew, it can help us determine the best type of option spread to use, because we want to buy low, sell high. So we want to buy low implied volatility and sell high implied volatility. So I'm looking at implied volatility in my options chain. And if I'm expecting the VIX to spike, which would typically correspond to a sell-off in the markets, I can do a number of things. I can just buy a VIX call. Problem with just buying a VIX call, look at the IV. It's very high, right? We're over 100% implied volatility. And what does that tell me? It tells me that the options are expensive, right? So if I just buy a single leg call, I'm going to pay a lot of money for it. And it's going to be more difficult for me to make money on just a single call than it would be on a spread. Because with a spread, I can, I might be buying absolute high implied volatility, but I can mitigate that and offset it by selling higher implied volatility. So that's how I decided to set up a bull call debit spread. So if I'm selling the 24 strike, buying the 24 strike calls with an implied volatility of a little over 105%, what I did to offset that is I then went out and I set up a 5-point spread and sold the 29 strike calls at the same expiration. And that strike, the 29 strike, has an IV of 110%. So that's significant volatility skew. But I bought the lower implied volatility and I sold the higher implied volatility. So that IV told me the strategy to use that gives me puts the odds in my favor as far as pricing goes. So I'm buying low and I'm selling high. I bought the low implied volatility. I sold the high implied volatility. And if the VIX moves up out of this support zone, this trade has the potential to make a lot of money, and it has a really good risk reward to it. So let's take a look at, let's see, the options graph and what that looks like. Attach. All right, so let's go over to VIX. All right, so in order for this bull call debit spread to make money, I need the VIX to spike up, and I've given myself 63 days for that to occur, right? So the blue line is our expiration date. So again, the spread will expire March 22nd. I don't necessarily intend to hold it that long, right? Very likely I'll close this spread out far before March 22nd. but I'm giving myself enough time for the VIX to spike. Now, we looked at the support zone between 18 and 20, so we're down in that support zone. So timing wise, it makes a degree of sense to set up a spread that would benefit from a VIX spike. Then we look at the resistance levels, like where could it spike to? And why did I choose these strike prices? Well, often when we've been down in this, these lower VIX levels in the past year, it's not unusual for us to spike up to, 29 or above. So I did a 5-point wide spread by buying the 24 calls, selling the 29 calls. And I put on, I put on a small position or relatively small for me, because I might scale into this. Again, I put this on maybe a bit prematurely, but if we do start to spike out of this support zone and the S&P starts to rotate lower off that trend line, I might add on to this position. So I seldom put on a full position all at the onset. So I give myself the flexibility while remaining within my risk parameters to add to the position, whether it's successful or unsuccessful. But if it's successful, I can still add to the position. But you can see if we get like a VIX spike, even up to 29, that's going to be actually my max profit potential at expiration. This spread would make over $12,600 at expiration. Now, again, I probably would close it out, and why would I close it out if we get up there before expiration? Well, because the VIX it often doesn't spend a whole lot of time at those levels, right? So when we do get spikes up into this, the last spike we had far exceeded 29, right? So here's my short strike right here around 29. We spiked up to around 35 back in September, and that was the last spike. But even this milder spike that we got back in December, we spiked up to 26. But you can see when we do get these spikes, we don't spend a whole lot of time up there before volatility comes back down. So that's why I'm saying I'm not probably, if we get a VIX spike up to 29, let's say like the next few weeks or something, I'm not going to hold this spread through to March 22nd. I'll go ahead and close it out. So this would be my P&L if I actually held the spread through expiration. But you can see that the reward on this spread, it's like probably about 10 times the risk. So it has like a 10-to-1 risk reward. But more realistically, if I close it out early, and we can change our dates here, like if I get a VIX spike, let's say early February, up to 29, let's say, I'd be sitting on a profit of about $5,000 on the spread. So that might be more realistic, but that's like, a 200% return on the risk. So it makes sense timing wise. We don't have full confirmation yet, which is why I gave myself some flexibility to add to the position if we do start to get a spike out of that 18 to 20 support zone, and then the S&P rotates lower off the trend line. So I'll pause there and see if there are any questions. Because if that doesn't happen, then I've got some backup plans as well. And it's one of them, I actually could have done at the onset of the trade and often do. In this case, I didn't, but we'll talk about that as well. But there any questions on that? That's one way to play a VIX spike. And often when we're down in this support zone or below 20 on the VIX, a bull call debit spread can often make sense, but you want to look at that volatility skew and make sure it's in your favor.
There's a couple questions. I'll ask them together. One is, do you take a max loss if you close it out? And second, if VIX measures volatility for 30 days, why would you select March 22nd?
So generally with options, if I'm a net buyer, I plan my risk accordingly so that in the sense that I assume it could be a max loss. So I size my positions when I'm an option buyer as if, worst case, I just lost the whole risk in the spread. Why did I set it out further? Because again, I'm just giving myself time for the VIX to spike. So I've got 63 days for it to make the spike that I'm looking for. It doesn't have to happen this week or next week or the week after, and so on and so forth. It's I'm giving myself time to do it. So as far as the VIX measuring volatility 30 days out, that's true, but that's kind of not really relevant to, obviously, if you look at VIX options expiration cycles, they go far past 30 days out. Right now you can buy, or you can trade VIX options all the way out to September 20th of this year, 245 days out. So I often trade expiration cycles on the VIX far past 30 days. But really the expiration selection is just to give myself enough time for two things, really. Number one, for the spike to take place, and number two, for flexibility to make adjustments to the trade. And since I am an option buyer, a net option buyer, right? This is a debit spread, so I'm paying money to put this trade on. Time as an option buyer is not in your favor, so you want to give yourself enough time for an expectation to take place. Whereas if you're an option seller, I wouldn't necessarily go out that far if I was selling an option spread. However, as I'm going to talk about in a second, if I could sell an option, and this is a strategy we've talked about that can be applied not just to the VIX but other assets, but we can also use with this VIX spread. Then I may go out and sell some premium further out to finance the spread. That's what we'll talk about here in a second. But any other questions there?
Yeah, that kind of leads into it. One question is probably more, it's fairly general, but going into the same thing. So if the VIX debit call spread run moves against you, how would you adjust it? And let's say it does, do you need to have enough cash in your account to cover it if the strategy fails? So it's kind of a
so it's a debit spread. It's a limited defined risk spread. So it's not a margin trade. You have to have the cash in your account to put the spread on, which of course can be adjusted based on your account size with how many contracts you trade. And also a consideration is, are you using this as a hedge or a speculative trade, right? So if you're hedging something, that's different than putting on as a speculative trade just to make money on that one trade. So if you got like a long portfolio, maybe a retirement account, and you're invested in like, the S&P and the NASDAQ or whatever, like index ETFs or something, and you wanted to hedge those, your position sizing would be different than if you were to put this on as a speculative trade. So that's probably a topic for a different day, because hedging is pretty complex and how to calculate the percentages and stuff. But the rule of thumb is you don't want to hedge off more than 30% of your portfolio risk. Otherwise, then your hedge actually can become a source of risk and not a true hedge. But again, that's kind of a more complex topic. So you want to consider, why are you putting the trade on? Is it, to hedge a long portfolio? Is it just for speculation? You want to make money on the spread? Because if you have a long portfolio and you set this up as a hedge, you're not going to make a net gain if you're using this to hedge a long portfolio. It's going to reduce the pain of a market sell-off, right? It's going to hedge you. But if you're just using this like as a speculative trade and you don't have any long positions to hedge, and you get a VIX spike, then you're going to have a net gain, right? So that's something to consider.
Another question I got is, do you consider any particular delta to put this on, or near the money trade? Or
yeah, so partly I use the the VIX levels, right? So I know where my support and resistance is and where the VIX tends to spike. So since I know where my resistance is, and if we do get a VIX spike, where we're likely to spike to at a minimum, and yeah, the VIX, I mean, tons of people were proven wrong back in February, March 2020, right? Oh, the VIX, it's not going to spike any higher, and it went all the way up to 90, right? There's a maximum profit potential on the spread too. So whether the VIX spikes to, which in this spread is 29, right? It's the long strike that we purchased. Whether it spikes to 29 or 90, the profits would be the same at expiration. It can differ prior to expiration, but yeah. So that's partly how I selected my strikes, is where are the resistance levels that the VIX might spike up into, and I want to set my long strike in my debit spread at one of those resistance levels. So that's partly how I selected it. When we're down in the lower territory on the VIX, between 18 and 20 or less, I like to use a 5-point wide spread. Deltas, if we're not actually looking at actual resistance on the chart, a delta around 35 to 40 for your long strike, it often can work pretty well and give you a good risk reward ratio on a call debit spread like this. And then right now my delta on my short strike is at 27. But again, if you just use that, I just kind of like to use a 5-point wide spread in these scenarios. Hopefully that answers the question, unless I missed anything there.
No, that's good.
Okay. Any others?
Let's see here. Stan's asking about how can you get a replay for all the people that came in late. Yeah.
Oh, yeah. Yeah, so Richard, you can let him know that.
Will do. Yeah, so it's on YouTube. You can check it out there. You can like and subscribe on the channel, and you'll see all the previous videos we've done. We've got dozens on there, so you can check that out. It's probably online sometime tomorrow, the day after the latest.
Yeah, we'll get it up in the YouTube channel tomorrow. It'll also be posted in our members area if you're a member of any of our alert services or have any memberships with us, then that will be in the members area as well. All right, so so I've got this spread. I paid a debit for. I think I paid like a 79-cent debit, so $79 per contract is what I paid for this spread. Right, so right now I'm keeping it as purely a debit spread. In past sessions, we've talked about selling premium to finance our option buying strategy. So like if we're buying a call debit spread, like in this case that I'm sharing with you, we can sell premium as well to finance that. So that has risks and benefits associated with it. But like, for instance, let's say, I pay for this spread, and then, although highly unlikely, we don't get the VIX spike in the next 63 days, and the VIX just stays down at low levels. I mean, it did that back in 2021, right? We still got spikes. So likely, if you look at like block out any 63 period in this box where we were trading down at much lower levels on the VIX for more extended periods of time, we were still getting VIX spikes. So even in that case, I probably could have made money on the spread back in 2021. But what if I just time it badly, and then we don't get the VIX spike, and the spread, starts to lose money. Well, there's some different ways I can adjust this. One of those is to sell premium against the spread, right? So there's many ways to approach that. I could even sell premium on another asset. Like I could sell premium on the S&P, the spiders, the S&P 500 ETF, the SPY, even because they're inversely correlated, but I can also sell premium on the VIX. So for instance, I could go out even further in expiration, let's say to the April or May expiration, and sell a lower strike put to help finance losses or cost of buying the spread. Okay, now this adds risk to the trade, right? Because if I sell a put, it can also lose money if the VIX gets too low. So I'm very strategic with how I do this. Like if I'm going to sell a put on the VIX, I want the VIX to really move lower. Probably between 14 and the chart can help us kind of gauge that. But if you look like back at 2021, we were getting down to I think we actually got below 14, just right. Like if you look at like June 2021, we were right down here, just hovering above, and they were really on intraday spikes to the downside, just above 14. Okay, so that serves as historically like a very strong base level. So we can use the chart to kind of help gauge that, but I can't get any premium out of the 14 strikes right now, even going out further out in expiration than I put my call spread on, 91 days. So, but that also tells me that, and I can look at 14, we only have a 7.7% chance of touching 14 in the next 3 months, right? So I'm just looking at probability of touching that level. So I also look at that, and that's, just building on what we talked about in past weeks. One of the things I really keep a close eye on are the options probabilities. And then, probability of this strike being out of the money. In other words, the VIX closing above that price at expiration. But same thing with the spread. If I were to sell, a put way out in expiration like this, my intention is not to hold it for the next 91 days. I'm just looking to bank some money off of either decay in the options premium, since I'm selling the put, or if a VIX spike does occur, then not only can I make money on my call spread, I can make money on the sale of the puts as well. So it can add to my profit if that spike occurs. But it also can help me finance the cost of buying. And I could set it up so I completely finance the purchase of that call spread. I could use it to defray some of the cost of the call spread. Those are all kind of things that are subjective. You can decide kind of on your own, based on your own, risk tolerance, available capital, all those types of things. But I could go out and sell an 18 strike put, which is below. It's at the lower end of that support range that we just looked at. And for every 10 contracts I sell, I can collect at the mid about $560. So even if I sold an equal number of contracts that are my spread, if I sold like 30, because I opened my initial call spread at the March 22nd expiration with 30 contracts, even if I sold an equal number of contracts, 30 18 strike puts, I would offset more than half of what it cost me to buy that spread, collecting about $560, for every 10 contracts. And then if I get the VIX spike, my call spread can become profitable, and I would also book profits on the sale of the puts. And so I wouldn't hold them necessarily, or I definitely wouldn't hold them all the way up 91 days till expiration. If that spike occurs, I'll go ahead and close these puts that I sold out for a profit. And so I'm probably looking for somewhere around a 50% profit, 50 to 75% of the profit potential if I were to sell some puts. If the spike doesn't occur, as long as the VIX stays above 18, I'm gonna likely be booking some profits on the sale of the puts. And this can be adjusted as well. If the VIX does drop back down like it did in 2021 to lower levels, I can certainly roll these puts out in expiration. So there's adjustments that can be made to the sale of puts too. And that's why it's so crucial that you leave yourself enough room in terms of available capital, and you don't over leverage or increase your risk threshold to allow for these types of adjustments. So I trade way under my abilities as far as available capital. If I could realistically, put on a trade with 300 contracts, I might only trade 30 like I did. So I trade way under what my potential is, because I leave room for the unknown. Like there's always the unknown. And so I give myself that flexibility to be able to adjust. So that's a way to do it. And I didn't sell any premium to finance the cost of this call spread at the onset, right? I'm giving it time because I've got 63 days. So I'm going to give it time. Maybe, we get a VIX spike fairly soon and I can book some nice gains on this spread. Maybe we don't. Maybe the VIX does continue to rotate lower. Well, I'm going to give it time to do that because I've got 63 days. And then that's going to increase my flexibility to sell lower strike puts to finance. So it doesn't have to all be put on at one time, especially and that's another rationale for selecting a further out expiration. I'm giving myself enough time for the VIX spike to occur. And if you look back at the VIX chart, you're going to have a hard time, if not impossible time, finding a 63-day period where the VIX didn't spike up, right? So there's all that rationale behind selecting that time till expiration. But so I'm really putting the odds in my favor there. But maybe, a month from now, at which point in time I'll still have 33 days left until expiration, the VIX is just continue to stay low. Maybe it's traded down to, let's say, 16. Well, then I can go ahead and go further out in expiration and sell, because then it's called legging in, right? I can leg in by selling a put to finance and offset any losses in my spread, and that will benefit the position when the VIX inevitably spikes back up. So then, and it will give me the flexibility to sell a lower strike put and bring in some premium to help cover losses or finance the cost of the call spread. So that's another way to kind of trade this type of expectation when the VIX is low. So any questions on that?
So Eduardo was asking, if you did sell premium on the VIX and it drops, would it be valid to adjust with the delta neutral hedge?
Yeah, you could. It can be difficult on the VIX because you can see, like, when there's a reason for this, right? Like the VIX is kind of like the mirror image of most other, like if you look like in an equity options chain, right? Usually you get the put side of the chain with far out expirations with significant premium. That's because the risk in people's minds is to the downside, right? So the VIX is kind of the opposite. You see all these strikes with high premiums going up because the VIX is inversely correlated. So it can become a little difficult to delta hedge a short put on the VIX because you don't have a lot of options down here. The premium drops off really fast. So there's different ways you can do that. You can do calendar spreads where you hedge with a further out expiration and stuff. But so yeah, it's doable, but I don't really rely on delta hedging the put side of a position on the VIX. For me, like if I had to adjust, and again, a reason why I don't over leverage. If I have to adjust a short put on the VIX, I'm going to roll it. I'm going to roll it out. And there you still have to be careful because you can get skewed there too. So you got to be really careful. Like you can go further out, you know, like I can even see if it's the case now. So we've got like, let's looking at the 18 strike, you know, we've got a mid around 53, 54. You know, if I go out to 91, look at that. It's only a few pennies higher, adding another month to the expiration. So you get backwardation, forwardation, kind of the terms that are used for these skews in the VIX expiration cycles. So that's something to kind of keep an eye on. But generally, you know, the way that I would set this up, like I can generally roll this out if I'm strategic with it for an equal or greater credit, but you just got to be careful on the VIX there. So yeah, I would generally adjust. Like if my short put got in trouble, I would look at rolling it out. But generally, I'm going to have to do that like right when it gets in trouble, not close to expiration. Any other questions there?
Nothing about the strategy. I got a request for his ticker.
Yeah, so we're gonna go ahead and open it up, do a little ticker roundtable. Just maybe take 2 or 3 since we're right up on an hour, but just want to make sure there aren't any lingering questions on the VIX, and kind of I wanted to share one of my actual trades with you guys and rationale behind it, and my expectations and things, so you can kind of get a feel for, and I'll be doing more of this, sharing the actual trades that I'm doing in my live account. I can't share anything from my hedge fund, unfortunately, but a lot of it is the same strategy. It's just I won't share the actual trade within the fund, but right now we're actually 100% in fixed note investments, so we're not doing any currently. You know, it's about to change. We're starting to dip our toes in a little bit in the markets, back in the markets with live trades within the fund, but I'm more than happy to share actual trades from my personal account. And so wanted to do that with you guys tonight, and I'll continue to do so moving forward. So yeah, let's go ahead. And if there aren't any other questions on that, we can go ahead and take a look at a few tickers.
Yeah, Boris asked early on a couple times. So could you look at the dollar yen?
Yeah. I have that one in there. I typed the symbol in wrong. Need the dash in there. All right, so dollar yen. All right, so it looks like we're out of, we had red divergence, dollar yen. Yeah, so we're out of the red divergence cloud. So we had this nice run up August, September, green bullish divergence, buy signal back early August, transition from green to red divergence cloud, sell signal. We got one on October 21st, another one November 8th, and then December 20th, December 30th, and more recently we've got an open one January 12th. So we've had some nice sell signals along the way, but we are out of bearish divergence. We've been trailing the lower volatility band for some time. So there is an open sell signal, which is kind of looks like maybe slightly in profit, but near break even currently. I think that there's a decent chance for at least a retracement. Let me redraw that a little bit closer to this support line. Because I'm seeing some pretty strong horizontal static support here. If you look at March, April, getting into May, we had the strong parabolic run up and then a pullback into right around the 127 level. Well, that's what we sold off into. It looks like it may be reversing. So that's the level I would really be watching right now on the dollar yen is right around 127. It would be a counter trend reversal until we start to break through some resistance, which would be kind of around 130.50, 131. You can see we've got prior support and resistance at this level. So if this roughly 127 level holds, that would be the next level I'll be watching for resistance on a rotation higher. And then, whether we resume the downtrend or break that resistance to the upside, as it relates to today's close, today's close, our center band is right around 132, which serves as dynamic resistance. These are obviously coming down, and maybe tomorrow our 2 standard deviation upper resistance band might be closer to 134. So kind of right now it looks like has the potential for a counter trend reversal back to the upside if this 127 level holds. If it breaks, then dollar yen could really tank because, looking back almost a year, there's not a whole lot of support to hold us up, 124 maybe. But it's really this 116 zone down here that I'd be keeping a close eye on if this 127 level breaks.
All right. Let's see. About DocuSign, DOCU. I had to check. We recently closed a winning put trade on that, so we don't have anything open on it.
Yeah. Hey, we use DocuSign quite a bit. Altos, not just the stock, but we actually use the service. Yeah, so the stock's really been stuck in a range. This is why we set up a spread for our a trade for our members on this one. It's not really doing a whole lot. It's obviously got hammered, pretty hard. Huge sell-off here. I think this was on earnings back started December. It was trading, up above 300. And it seems to be kind of forming a base right now. So, not a fundamentalist. I other than I use a lot of people, obviously a lot of companies use DocuSign service. I think it's a solid company, and it could be without knowing the valuations and stuff, could be a bargain hunting opportunity here. But after this extreme sell-off in the stock, it's really based between this 40 and 65 to 70 level. But I kind of really just consider this a ranging zone until the stock can break out of it. So for me to really get bullish on it, I'm just drawing like a bunch of levels here, but in the medium to longer term, I don't want to see it make a sustained break above 75, but it's got several levels of resistance to get through within this range for that to occur. Nearer term, it's got a buy signal on it. It looks like it was actually taken out today on the trailing stop. Just would have been a slight loss here. But I stay away from signals like this, and in choppy price action, sideways movement. Obviously we're not getting much directional movement, and we're kind of in no man's land right now. Looks like we might be getting some so we had volatility contraction here. So this is volatility expansion, and this is volatility contraction. You see how the range of the candles, the high and low, gets much more narrow. But in particular, if you look at Friday and some of the candles within last week's price action, there's quite a bit of, and even weeks prior, quite a bit of volatility contraction, but we're starting to get some expansion here, and it was to the upside. So, near term, if we can break up through 6150, which was the high from back on December 14th, near term, it has a little bit of room to run, but not a whole lot, maybe up into 65, 66 level. All right, let's take a look at one more.
Shopify.
Okay. Yeah, so Shopify seems to kind of be breaking out here. We are getting volatility expansion here. So again, see, the narrow range of these candles. Remember, all assets are either, in terms of volatility, either contracting or expanding. And it's usually the trend that precedes, the volatility expansion, and then it's followed by contraction, and then we get expansion again. So see how we went from this period of volatility contraction to volatility expansion, which occurred on Friday. It's contracted a bit day to day, but we look at contraction and expansion more on a weekly basis, more so than a daily basis. So this, we're still, as far as the range, wide and bullish, and we're getting another way to gauge on a kind of more of an aggregate gauge volatility expansion when we start to trail a 2 standard deviation band, and we see the outer standard deviation bands diverging, moving away from each other. Next step is we want to look at the center average band. Is it sloping? Which direction is it sloping? In this case, up. And we're trailing the upper standard deviation band. That can be a volatility expansion or breakout to the upside, which is kind of taking place right now. But with that being said, we've also got significant overhead horizontal resistance in the zone. The near medium term zone resistance is at 41 to 43. The medium to longer term zone resistance is 43 to 45, 46. So if this volatility expansion continues to the upside, these are the areas of resistance where we have a higher probability of a reversal back down. Historically, I'm just looking at price action from these resistance zones in the past and the magnitude of that rotation from these levels. So this one, very near term, may have some upward potential with, again, more medium term risk for another leg lower. So thanks for sharing those, guys. Those are great ones to look at. I appreciate that. I hope you guys got a lot out of the session tonight, and have a little bit of a better understanding on the VIX and how to analyze and interpret it. And if you decide to trade it, how to, some different ways to set up spreads based on expectation, or different option strategies you can use to trade VIX spikes. So that was kind of the purpose for tonight. And I hope you guys got a lot out of it. Any final questions to wrap up?
No, we're all good.
All right. Well, if you guys, thank you, Lalit. Thanks, everybody. Raju, Rosemary, Charlene. Thanks to all of you. Thank you, Sergio and Mike. And yeah, we'll plan on seeing you guys next Tuesday, same time, same place. If you have any questions in the meantime, you can shoot us an email, support@altostrading.com. Thanks to Craig and Richard for hosting and moderating and helping answer questions. Hope you guys have a great rest of the week, and we'll see you guys all next Tuesday.